Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Uh, it's been 2 weeks since I've done this podcast. The first week I was off, taking some time off, and last week was just too many companies to cover, and it was just too overwhelming. But now we're back. So it's Friday. I try and get this out by 9 a.m. Eastern time. So yeah, that's the kind of when I try and get it out. I think it's kind of interesting to notice and look back how the past several weeks have been. I've been saying this quite consistently that towards when the market is kind of really uncertain about something and is looking to change direction, whether it's kind of like the momentum's kind of going down and then it's kind of looking to go back up, or when it's at the top coming down, it's really volatile when it's looking to change direction. And this is what you see right now. It's like some days, like I just follow small and mid cap stocks, so I'm not really interested in what Tesla is doing. But some days it's kind of like everything is green, and other days it's really brutal. And yeah, so we got three topics. I've called this episode 21, The Drop. What's going on? So we're going to talk about the macro scenario. We're going to talk about the fact that it's just now it's all just one trade in the small mid cap tech stocks. And then what you need to do right now. What's the strategy that I'm following? And I think that is a suitable strategy for, for anyone that's kind of reasonably willing to kind of have a slightly longer time horizon than, let's say, 30 or 60 days. Okay, so what I really like to look through and read other people's comments is that macro investors always have an answer for everything. Like, whatever's happening, they always have an answer, but most importantly, they always knew what was going to happen, but they didn't tell you. They tell you after the event. They tell you what has happened. They're really good at telling you what just took place, and I really like that about macro investors. They never have any problems in just telling you that that they knew, but they were just kind of keeping quiet. Anyway, so obviously the war in the background. You got interest rates going higher, and then inflation, and then supply chains, and all kinds of. It's kind of interesting. I know a lot of people have come to kind of anchor themselves to what was happening after the dot-com bust, and this is now like everyone is talking about it. When everyone's talking about it, sometimes I feel that it's kind of worthwhile just to unpick that slightly, and there's a bit of nuance. But when it comes to it, there is a lot that rhymes with that period, and I'm also kind of falling prey to that. That being said, I do believe that there's some really great companies out there that, yes, they probably are quite young in their cycle. They're only, let's say, 10 years old or even less than that, and they have a really great future ahead. But because they got caught up in this bracket of quote unquote being disruptive or innovative, the market wants none of that to do with anything. If you're watching this, I'm quite confident that you know one investor that is been heavily invested in these kind of innovative companies, and then that investor has really taken a hit lately, and everyone is just kind of like, okay, enough of this, just poof, dumping everything. And it's been quite undiscerning, and I think that it's quite interesting because I went out for my job this morning. I was kind of thinking to myself, okay, when I know this kind of like looking at hindsight bias and looking at the stories that did work out. We're not looking at the stories that did not work out. So there's some kind of survivor bias as well there. But I remember when John Templeton was on the story is the John Templeton on the eve of World War II kind of went all in and bought every stock under $1. So obviously this is not the same kind of setup, right? Companies are really quite expensive relative to how they were on the eve of World War II. There's still some really expensive infrastructure SaaS companies. There's a lot of companies that, I don't want to put any names on them because I know that some people that watch this, they kind of own those companies, and they like, when I start saying bad things about the companies that they own, their mind associates like, oh my god, Michael doesn't know what he's talking about. But so I kind of want to try and keep it quite in general, unless it's a stock that I personally own, then I'm quite comfortable to talk about it because then I'm putting my skin in the game. But it's kind of interesting because on the one hand, stocks are nowhere near as cheap as they were on the eve of World War II. But on the other hand, these companies, they can really go from small revenues to really, really significant revenues, and their earnings power can be really, really strong. Whereas previously, if you, let's say, you had a plant and you had to build that plant, and then you had to kind of build a second plant, and then you have to go and build a third plant, and that takes a lot of capex, and it would be really difficult to grow those revenues, and it take a long time. So those businesses are not the same landscape, because nowadays it's so globally interconnected that businesses can, if you have if you're able to solve a problem for the consumer, you're able to solve that for one batch of consumers. You can quite quickly extrapolate that to Europe, and then you can go to other places as well. So it's not really the same, and that's why valuations haven't really come down to that level, let's say, of trading for less than book value. But on the other side of the equation, countless stocks are down significantly in the last several months, and I think that I think that that's quite an interesting setup that I wanted to just highlight. That there's a lot of, at this moment in time, there's so much panic, there's a lot of fear, and I've always been saying for the last several months, I've been saying, okay, we're towards the bottom right now. The risk reward is really strong right now. That does not mean that it cannot go lower. What it does mean is from this point over the next 2 years, it's going to be higher. But that doesn't mean that it, cannot get worse. On each day, there's a lot of pain. And it's kind of interesting to think about that. There's just so much noise in the social media space. And there's so-and-so saying that, supply chain is causing trouble, and then it's going to cause a knock-on effect to some kind of inflation problems getting worse. And there's just so much panic right now. But there isn't a lot of optimism. So I think that with that backdrop, I think it's a good time to be an investor. But nobody really wants to think about that right now. Everyone is just so obsessing and looking at the share prices every single day. And when there is a tiny bit of good news, it'll be too late, because stocks move in anticipation of the good news. When the good news is out and about, it's like you've already missed like the bottom, like 40%, and it's going to rally strongly when it does. But it's difficult to be a market timer. It's much easier to just be spending time in the market and compounding that over time. But everybody says they want to do that, but when there's blood on the street, nobody really actually wants to do that. And I find that everyone talks about, I remember the story that back in November 2020, someone used to tell me, oh, I really wish that I'd invested very aggressively on the COVID, when COVID dropped. It was obvious to me. And everything is always obvious to everybody in hindsight. Everyone is like, oh yeah, I knew that was obvious. But in investing, it's never obvious. But anyway, so yeah, I kind of went on a little bit, but I just wanted to kind of highlight some of those things. Now, this is something that I think is quite interesting, okay? So I've just highlighted different companies, and I hope that you'll agree with me that these companies don't have that much overlap. So, for example, what Magnite does is an advertising company, hasn't got that much to do with, let's say, what Block, used to be called Square, does, hasn't got that much to do with what Wayfair does. All these businesses are pretty much down somewhere between 60, 65, around that ballpark. So, in the last 6 months, it's been irrespective. So it's just become one trade. You can see here, it's like there's not a lot distinguishing whether the management is a founder, whether there's the margins of the businesses are better or worse, whether the total addressable market, none of that has mattered. It's become so one traded. And with the benefit of hindsight, it's just been that kind of round tripping. So it was from the start of 2020, these all went up together as one trade, then plateaued, and then down one trade. So we're back to where we were in many cases, either to the onset of COVID or pre-COVID. But what's particularly interesting is that many of these businesses have actually shown that they're well adapted and have actually move significantly higher in terms of their business model. The intrinsic value has actually grown significantly. At the same time, a lot of those share prices have come down quite significantly. That being said, the counter argument to that is that a lot of these companies have been really fast and loose with diluting shareholders with stock-based compensation. And that's been something that everyone's now all of a sudden talking about it. I've been talking about it for a little while, but I don't want to be a person with all the answers because I've also fallen quite prey to that. But everyone's now thinking themselves, okay, so you have X, let's say, non-GAAP gross margins. Let's say they're 10% non-GAAP gross margins. And then you think to yourself, okay, of that, is pretty much all of that, of the EBITDA figures, all of that is stock-based comp. So you have to pay your executive team, and a lot of the stock-based compensation that is now worthless because a lot of those management teams are underwater and they're thinking to themselves, the climb from here back up, it's going to take me several years. So all that stock-based compensation doesn't carry that much value. And they think to themselves, okay, I need to get paid in, actual cash because that stock isn't worth much. And it puts, so they go and say, okay, to the board, either pay me in cash or I'm going to go to another company that's actually, doing something well and that the stock is actually worth something. Because it does something psychologically to the person when they're working in the company, they're getting paid stock-based comp, and they see let's say the 200,000 shares are worth, let's say, 3 million, and then all of a sudden it's worth, let's say, 700k. It does something psychologically to the person and to the team. And if the management wants to retain those executives, they're going to have to kind of pony up some cash, and it will become a case that non-cash expense, which is stock-based compensation, added back to those free cash flows, will soon become an actual cash expense, so the free cash flow will come down and it become like a vicious cycle because the free cash flow will come down. That means the shares will continue to slide. So I can see both sides of the argument. I'm inclined to believe that in many cases, the free cash flow that the business makes, including stock-based compensation, could, if the business is so desires, to offset with repurchases so that at least the dilution from the stock-based compensation wouldn't meaningfully increase the number of shares outstanding in any year, if they so desired. If they wanted to take the foot off the pedal, because the management teams, they're looking at the share price every day as well, and they're thinking to themselves, okay, the shareholders are no longer rewarding growth at any cost. Now the big topic of the day is how we manage our dilution of the share price, the dilution of the total number of shares outstanding, and they think to themselves, okay, I might as well just not invest so aggressively over the next 2 years, buy back some of that stock, get shareholders back on board, share price goes back up, management team is happy, everyone's happy, and then they can kind of probably go back to investing into the business growth at any cost. But so there's going to be a bit of a period of time where management team will have to kind of, change or quote unquote pivot their strategy, because if they don't, ultimately, an activist shareholder will come in and just do it for them, because this is inevitable. A lot of these companies have really great platforms, so either the management team does it themselves or someone is going to come in and do it, and you can make the case that in a lot of these scenarios, the executives, the founders, they have Class B shares and they have a lot of voting power. But yes, they do have a lot of voting power, but if you can't sell those Class B shares in the market because your stock is down, it's like you're back to square zero. So they're also kind of having to react to this in some instances as well, as well. Okay, just let's see. What was the other thing that I wanted to talk about today? This is one of the questions that kind of came up to me recently. What can I do right now? So someone said to me, is it a good time to start putting stop losses on my stocks? And I can tell you, hand on my heart, that back in November 2020, I should have sold a portion of my stock. I did not sell that. And now in 2022, when everything is down, let's say 70%, I'm thinking to myself, I should have done that. I did not do that. that's done. That's in the past. I can't deal with the past. But to exit the market right now, there's no point. It's like we already down 70%. But then I can say the other side of the equation is I know for certain that cheap can always get cheaper. And it not only can get cheaper, it can get so cheap beyond rationality. And it can really, really cause a lot of pain. If you spend a lot of time reading financial history, obviously the classics, like say when there was the Russian implosion in 1998 with long-term capital, and you kind of see the 2008, the dot-com, 1929. If you kind of study those, and you can see the reports of people, not like the famous investors, but the people, the actual people investing in the market at the time. If you read those from John Brooks is a good author that kind of follows that kind of stuff, and you read the pain that those stocks were under when there's an actual, when things get so absurdly cheap. So just because something looks cheap and is down, let's say 60-70%, does not mean it cannot fall another 67%, 70%. It absolutely can. But I'm inclined to believe that the risk reward, if I think through this and I think myself, okay, in let's say 2-3 years, from this valuation over the next 2-3 years, I look at the number of the amount of free cash flow the business can make, and I'm paying, let's say, 20 to 30x next year's free cash flow. I kind of try and think like that. I think, okay, it's, even if things go a bit haywire, fundamentally, those businesses are still growing at 20 or 30% compounded annual growth rates. So I think that it's, the risk reward is favorable. Now, it's never ever clear. There's never ever, clear cut answers. But I kind of look at it, for example, in this manner. There's starting to be, the market is starting to discern between businesses that make today free cash flow, as in I call it jam today, versus businesses that the free cash flow is going to be some time away. So for the one example that I highlight you often is Upstart. So Upstart, it's kind of down significantly after Q3, but from its, the absolute bottom, when it hit $73 a share a few weeks ago, it's now to about 135 or 140. So it's up about 80% in several weeks. So that the market is starting to kind of sift through and say, okay, this business makes free cash flow today. It's probably worth something. I'm not going to just throw it out in the basket outside anymore. And then you look at something else that, like, say, I don't want to kind of point out any names, but there's some businesses that are still meaningfully unprofitable. And in those instances, the market is just saying to themselves, okay, I don't feel that it's really worthwhile anymore paying any price for this, and they're just kind of throwing it out. You see that a lot with some of the SPACs, but even the SPACs, if you look at them, some of them, they're still growing quite significant rates of returns, and they've been absolutely demolished because that also has been just one trade. Although, incidentally, I would say that the SPACs actually have stopped selling as much since, I would say, going into the November period, and now it's kind of like they've just kind of ticking along the bottom, whereas it's been a bit of a shock for other people because they won't invest in that space at all. So I think it's quite an interesting dynamic right now, and I think that the biggest takeaway that I'll make is that don't put yourself in a position where you're going to get yourself overwhelmed. Try as much as you can to average into your positions every 4 or 6 weeks. Put a little calendar setting for yourself, and don't try and kind of time the market or how the news feed is looking. Just average into your stocks, and try, I know it's difficult, but try and have a longer time horizon than 60 days. I know that right now no one wants to have that. Everyone's just glued to their screens and see how things are unfolding all the time. But if possible, I think that's a really good investment strategy. Not to get yourself too overwhelmed trying to buy the dip, and then if it's not up in the next 30 days, you kind of, I'm out. Just try and kind of get yourself aligned to buying into companies, thinking like the owner of those companies, trying to position yourself, okay, I'm the owner of this company, I'm trying to see with pride and with pleasure how my businesses are doing, and following that, and learn to sit on your hands and kind of just having that slightly longer term time horizon. Okay, it's been a while since I've done this. I'm really grateful for everyone kind of tuning in. I really appreciate your time. As always, I'm going to ask you, please drop me a like if this has resonated well with you. And also, I'm going to say, don't forget to check out my marketplace, right? Deep Value Returns, okay? Check out what other people said. Check out the reviews on my platform. And yeah, I highlight for you high quality, actionable investment insights, okay? Thank you so much for listening, and I'll see you next time. Bye-bye.